Did you know every company has the ability to just change those indexes on an annual basis? When you buy a whole life policy, when you sign on the dotted line, you are becoming a partner of the company, essentially a shareholder of a participating mutual company. Most of the IUL agents out there on TikTok and Instagram that have gotten really popular, gained hundreds of thousands, if not millions of followers, is because they're selling hype, they're selling sizzle, and there's no stake behind the sizzle. And the reality is they've only been doing this since 2019, maybe even less. What's going on, Cashflow hackers? It's Chris with Life 180, and today we are talking about the 6 lies Index Universal Life agents use to sell IUL. Now, out of the gate, I got to tell you, this video is inspired by one of my most popular videos. That is the 4 lies Index Universal Life agents use to sell IUL. And ultimately, this is just an update because, let's face it, as time has gone on, IUL has evolved, and IUL agents would have you think that it's evolved in a positive way for your benefit, but I'm going to tell you that the only thing that's evolved is the bullcrap they use to sell the stuff. And so the purpose of this video is to show you the difference in the way that it's being sold today. And if you haven't watched my other videos, you could see the 4 lies used to sell IUL is probably one of the more popular videos that I have going right now. I also have the 4 lies used to sell IUL in 2023. And here we go for 2024. We are up to 6 lies in 2024 because, you know, they just got to get more and more sneaky to get you to buy their garbage. And so here we go. Let's, you can see I have a list behind me. What I'm really looking to do in this video is to educate you deep depth on how this stuff works. Because let's face it, if you are an agent and you're looking to sell this stuff, you better know what you're doing. Because if you don't, and you put your friends and family into this, your business colleagues into this product, you are going to damage a lot of relationships from a long-term perspective, and it might not be something they can come back from. If you are somebody who's looking to buy this for yourself, I just believe you have the responsibility to do your due diligence and really understand what you're putting your money into, because this could potentially be one of the bigger financial decisions that you ever make, so you cannot get it wrong, right? And so the purpose of this video is to kind of build off the last 2 videos. If you haven't watched those, go back. I'll link them in the description below. I'll put them in the comment section as well. You can go check it out. They'll all be there. I really, really suggest everybody check that out, but don't go anywhere. Make sure you watch this to the end. If you find this valuable, make sure you like it, share it, get it out there to people. If you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. So let's do this. Lie number 1. Let's talk about this. This is going to be a lot of fun. So lie number 1, you can see all the lies here, but illustrated rates are conservative. How many times have you heard an IUL agent say that an illustrated rate is a conservative rate? So here you can see when we talk about illustrated rates and they say that they're conservative, let's talk about why. You can see here on this screen that we have different indexes available. Now, every IUL out there is going to have a page that looks similar to this, or at least flows and functions and gives this kind of information on it. Every company obviously presents its information in a little bit of a different fashion, but there's going to be stuff like a cap rate, a participation rate, a spread rate, and I'm gonna let me break all these down so you understand them as I go through this video, because they're all going to come into play. A cap rate is basically the most amount of money that you can earn on a given year in the index through the indexing strategy. What does that mean? So you can see a floor rate is the bottom. So 0% guaranteed floor. Right now it's currently 50 basis points. And it's got a 9% top, but it can be lowered to a 4% cap rate. Think about that. This company has a 9% cap rate, but that can be lowered to 4% if it needs to on a guaranteed basis. Now, do I think the insurance company will ever lower it to 4%? No, I don't. But I'll get into that more as we go. Participation rate, meaning how much are you participating in the market, meaning the index? If there's a return and the cap is 9% and the participation rate is 100, that means you're getting 100% of 9%. You could do a cap rate of maybe 140, and that means you get 140% of whatever the return was, up to 9% is what you could earn. So if the market did 5% that year, if the index that you had the option strategy investing in, which inside of the index in the policy, if it was 140% participation rate, that would mean you get a 2% bump on the 5%, so you'd get 7, not 5. But it's, once again, it's another lever that they can move. Spread rate is usually what comes into play on an uncapped index. And then interest rate strategy, charge rate. This is like if they have any charges on different indexes, this comes into play. And then what it does here is it shows you based on, and this is a page that is used to sell pretty commonly, because what they do is they say the illustrated rate here in this is 5.91, 6.08, but let's just focus on this cap right now. It's 5.91%. And they go, look at this. We're illustrating at this 5.91 is pretty conservative because the 30-year historical average is 6.22%. I'm going to go through all this and show you why nothing could be further from the truth from a perspective of this thing performing like this and performing like why these numbers don't really have that much to do about it. And there's a lot of variables that come into play. And the reason I say this is because when you look at this, if we look at the floor rate here, and they say, the floor is your hero. 0 is your hero. Is like, they like to come up with these fun things. 0 is your hero. So if 0 is your hero, then the cap is the trap, right? Because if this policy can never make above 9%. And by the way, I have policies that I've seen that clients have sent me that were sold at 12.5% cap rates and are currently 6.75%, 7.5% cap rates. And when they were sold at that, the illustrated rates that they were sold at are 5.91%. So what happens is, the rates that they were sold at were not 5. They were over 8% back then. This is 5.91 now, right? So over 8%. Now the cap is lower than what the illustrated rate was back when they were sold. And so that just shows how dangerous these things can be. And when that happens, there's like zero chance of those policies ever succeeding, right? And I think that's a really, really important thing to understand. So remember, if 0 is a hero, then the cap is the trap. And this is something that you really need to understand. Now, before I go into anything else, I do want to let you see that there are other indexes that have no caps, right? They have different participation rates. They have different spread rates. Some of them have no spread rates. Some of them have different strategy index charges and fees that happen every single year. But you can see this is like totally absurd. What happens is these are what we call proprietary indexes. And these things are just a joke, in my opinion. I'm going to get into that more later because it's one of the lies that I have. But look at this, the 30-year historical average of 10.77 all the way up to 14.12. And so they go, of course, if these are averaging this over that period of time, well, 6.08 is super conservative. Well, guess what? This index hasn't even existed for 30 years. This is a historical look back. Look at down here. Look at down here. I want to read this. JP Morgan, Mosaic 2, established 12/28/2016. And the New York Stock Exchange Zebra Edge established on 10/11/2016. So these indexes were created just for this IUL, just to look good. Do you know why these were created? Did I mention AG 49 in 2015? AG 49 was created to rein in illicit illustrative tactics in the warfare, the illustration warfare. So 2015, these companies all of a sudden had to lose the ability to be in the wild, wild west of selling IULs. So you think it's a coincidence that in 2016, they came up with these proprietary indexes to be able to illustrate higher, to make it so even though they're not really going to perform like this, they're going to make it look like they're going to perform that way. That way you'll buy their garbage, right? That's what's happening right now. And so it was in 2016, they created these indexes. They created a hypothetical look back test. The performance shown is back tested by applying the index strategy to historical financial data when all companies are available and was designed to the benefit in hindsight, designed with the benefit of hindsight, right? Think about that. Designed with the benefit of hindsight. Back-tested performance is hypothetical and has been provided for informational purposes only. That's funny, informational, but that's exactly what they're using to sell. Like, and they sell it like it's, they sell it like it's this amazing tool, right? Like that because these proprietary indexes like have performed this well, there must be some secret. There's got to be some secret to that success. You know what the secret is? They got to look back and they got to put together an index that performed for a couple of years, and then they get to look back and say, whoa, if this pile of investments had been invested, if we've been holding these assets for the past 30 years, this is what it would have performed at. So that's what we call a hypothetical look back. They get to cherry pick all the best investments to make it look as good as possible just to sell their crap. That's really what it comes down to. So to say that the illustration's based on these assumptions, because when you look at an illustration on an IUL, you're basically looking at an illustration with today's current assumptions, right? And that's how it goes. Like that's what you're banking on, right? And so let me see here. I got to see if I can get to the right page, just kind of see this. So yeah, in this one, you can see these things. Yeah, it's irrelevant. But that right there, understanding that those numbers are just what goes into the assumptions of these policies actually performing the way that we want them to perform, the way that you need them to perform for you to actually be interested in buying this policy. If that's what you're banking on, you are in a lot of trouble, because the assumptions of these 6 and 7% returns inside of these IULs, they're going to tell you that they're good. But if zero is a hero, the cap is a trap. And if your cap, if the most you can ever earn, I don't know if you realize this, but if the most you can ever earn is 9%, then that is going to crush you. And the reason is because when you start taking loans against the policy, it completely decimates your ability. And I'm going to talk about that more later. So make sure you stick around for later in the video here. And so you know how I was saying that if zero is a hero, then the cap is a trap. Well, I want you to take a look at this little bit of information here. So this is a different company. This is a Mutual of Omaha, and this is actually an MPI illustration that I've had the privilege of taking a look at. And what you can see here is, as we look through this, this is a 20-year historical look back, and this is the best to show a good S&P annualized return index. And what you're going to see is that we have 1, 2, 3, 4, 5, 6, 7 years where the policy performs worse than the cost of borrowing, which I did this here, but that really also comes, there's no other like in between ranges, because you can see here, we got a lot of big years that you're losing the opportunity to take advantage of, with 23%, 12%, 26%, 13%, 29, 13, 19, 28, 16, 26. Those are all big returns. But in this instance, because this company has a 10% cap rate, you are completely limited to what the cap is, right? Now, they say zero is a hero, but the problem is when the most you can make on the upside is that 10%, then what happens is you get completely stuck as far as the ability to kind of catch up. You're not going to be able to have those big years. Now, what happened also with that is that these companies say that you are able to do no cap indexes at this point in time, which, you know, to this company's benefit, they don't do that. But other companies are using proprietary indexes or using no cap indexes as if there's some good long-term solution. But the problem is they just don't work. And the reason is for that is if, like, first of all, if you're going to do an IUL, one of the rules that I'll kind of give you to kind of follow is to say that you should never do a proprietary index, because those indexes that work with the historical look backs and they've basically cherry picked their investments to look good, they come with other fees. There's always a catch to them. I promise you, do the research, read all the fine print. Every company is a little bit different. All the fine print and all the individual proprietary index or engineered indexes, they all work a little bit differently. So you got to be really, really cautious. Read all the fine print of every single option that you're contemplating. I wouldn't do an IUL with anybody's money, especially anybody I cared about. But what I would say is if you're going to do it, you need to do just a straight up S&P 500 index. The reason they started going away from the S&P 500 index is because of the fact that the S&P 500 index options costs are getting catastrophically expensive. Now, to finish point number one here, what I want to do is give you one moment of education talking about how options work. So, and talking about how money goes into the index. So basically, if you have, let's see here, if you have $10,000 going into a premium, some of that's going to go to the insurance cost, right? Some of that's going to go to the insurance cost, and some of that is going to go into the cash value. Now, what's going to happen is out of the cash value, that's going to create an options budget. let's say 10% goes here if it's a really well-designed policy, and 90% goes here, okay? Give the benefit of the doubt to the insurance agent saying do that. So what's going to happen is we have an options budget of $9,000, right? So how is the options budget category created? So basically what we have to realize is the general fund of the life insurance company is where this $9,000 is going to go sit and reside. What's going to happen with this is this $9,000 is going to create based on what they know they can get for a return in the general fund. Let's just call it 5%. If the general fund knows they can earn 5%, well, 5% of $9,000 equals $450. This $450 becomes the options budget. This is the simple way in how they say, you know what? We're going to provide upside potential and downside protection. So the downside protection is saying, well, they're basically taking your 5% and they're going to risk it on options. And if you lose it, that's there. You lose the $450 and you still got the $9,000. That's how they do it. It's sitting back there. They're risking this. So the question is, what does that $450 get you? And how is this budget calculated? Well, first of all, you have a 5% budget. If that number goes down, then the budget goes down. If it went down to 4.5%, you'd have less of a budget. If the general fund performed at a higher rate, say 5.5%, you'd have more, right? That's just, it's a simple way how it works. But for this case, we're not going to worry about that. We're going to assume a 5% assumption, and it's going to have $450 of options budget for this account. And so what is that going to do? That's going to go and buy call options. And for this example, we're going to say options of the S&P 500, call options. So what does that mean? What's happened is it's a supply and demand issue. The longer IUL has been around, the more the S&P cost has gone up because more companies have flocked to the industry. More companies are interested in selling IUL because they are the most profitable products that insurance companies sell at this point in time. And if you look at that, so all these companies, when I sold IUL back in the early 2011, 12, and 13, when I was selling it, there were about 14 companies selling it. Now there are over 70 companies selling it. And now back then it was like millions of dollars going after, tens or maybe hundreds of millions of dollars. Now it's literally hundreds of billions of dollars that are, tens of billions of dollars. And, I think it's over $100 billion that have gone into IUL over the past 5 years. So when you look at that and you realize like, holy crap, that's how much money is being put into these products and how much people are giving up control of their money. What's happening is this is driven, if you understand options, it's a supply and demand product. The more demand goes up, options costs go up as well because there's not an unlimited reserve of call options. They have to be priced accordingly. So if you have this $450 budget for them and then the demand goes up and the cost goes up with it, right? Then you get to buy less call options. This is the reason that cap rates have gone from 16% in 2013 to about 9%, 9 to 11% in 2024, right? This is why. Even though interest rates have gone up, like what's happening is cap rates can go up a little bit and they can fluctuate, and they have gone up a little bit, but long-term cap rates are going to be doomed because of the fact that the metrics that go into this number, you can't fight the math of how this works. And so before we do anything else, before you get into anything else, you have to understand that this is how these things actually function. And so it's important to understand that. And I would say, just make sure that you understand the design of the policy. Make sure you understand that you are not investing in the S&P 500. You are taking part in an option strategy. And there's a lot of different variables that go into the mix here. The returns that you have, I did an interview with a guy named Bobby Samuelson from Life Product Review. And in that interview, he says every single given year, those illustrated rates are set to say you got about a 50% chance of meeting it or exceeding it, or 50% chance of being less. And if that happens, the problem is on the less years, there's a cost because of the annual renewable term cost. Anytime those policies perform worse than illustrated, what happens is the cost of insurance, everything gets kind of out of whack, comparatively speaking. That doesn't even account for the loan rates and what happens when you have outstanding loans on the policy, which you're inevitably going to have at some point in time once you hit retirement. And so I really, really encourage you to keep watching, because I'm going to get into that specific topic as we go through this. It's one of the most important things that you can understand, because at the end of the day, you bought this product if you're thinking about buying this product, hopefully you haven't bought it yet, but if you've purchased this product in IUL or you're contemplating, you don't really care so much about how it works in the short term unless you're thinking about infinite banking or using it for real estate, which if you're doing that, I got another video you got to go watch on that, because it will show you why you cannot use IUL for infinite banking. But even from a long-term perspective, once you take loans against these in retirement, that's where you have to be really careful. And that'll be, I think, point number 5, but I'm going to get to there shortly. So that said, let's go back to this. And so no cap indexes offer huge growth. Now, this is not the case at all. No cap indexes do not offer huge growth because there's always a catch. There is always either a spread charge. There's always either a spread charge a no risk rate, or something that's involved. And typically maybe it's a low participation rate or something of that nature. But this was a response. What happened is in 2016, because of AG 49, they came out with engineered indexes. And what they did with these indexes is they did no caps. And this is where these things became popular, right? Engineered indexes, no caps. And so in order to do this is what I showed you on the first slide, and with all the different index types, right? And so what happens here is there's either a spread charge. On that one instance, we're looking at a 10% spread charge. What does that mean? A 10% spread charge means that the first 10% that the S&P 500 does, you are not getting anything. You're uncapped above the 10%, but holy crap, it's never going to do that, right? Like, I mean, it's not that it's never going to, but from a long-term perspective, that doesn't make any sense. Yeah, sure, on certain years you can hit total home runs, but it's not a long-term sustainable thing. Remember, you're not buying an IUL or any life insurance product to speculate on potential growth. You don't want to take risk inside of your insurance policy. You want your insurance policy to be the foundation, to be the bedrock of your personal finances that you are not taking risks with. The other thing here is that every IUL has something buried in it called every IUL with a no cap rate has something buried in it called a no risk rate. And this is basically saying it's the cost of doing business with a no cap. And it's basically the 10-year treasury, 10-year treasury, which I don't know the rates right now. I think they're like 5.5%, something like that. Right now, meaning the first 5.5%, even though it's a no cap rate, that first 5.5% eats away at the growth. So if this thing is illustrated at, what was it illustrated? 591 was the illustrated rate on this, right? So that means if the market, in order to get the 5.91, you got a 5.50 plus 5.91 is 11.41. So the market has to average 11.41% to hit this with that no risk rate. Is that possible? Maybe. I don't think so. It's just doing simple math. But when you look at the no cap rates and you realize, like, a lot of people are going to say, oh, well, guess what? I'm going to manage your no cap rate for you. And like, we're going to find the down years and we're going to keep it in a safe index while the years are tough. And we're gonna put you in a fixed rate when, like right now, because the market is high and prices and all that are overly inflated. So we're gonna manage your money in an IUL like a money manager would manage it. And then on down years, when the market goes down, now we're gonna have an awesome opportunity to take advantage of this no cap index. And so you can get these huge returns. And people like Doug Andrew have like basically showed people these IULs that performed and got 100% return, like 64% return, something crazy, from like March 31st, 2020, all the way to like the 2021, and basically the bottom of COVID to the top of the recovery, right? And that happens. Don't get me wrong. It's not that it's not possible. This is the thing that I want to understand. It's not that it's not possible. I'm not trying to say it's not possible. It's certainly not predictable. And you're certainly not buying a fixed life insurance product depending on the person you bought it from to manage it for you. If that's what you're relying on, is the success of the agent. Listen, I'm good at this stuff. And if I believe that were my job, then maybe I would sell IUL and maybe I would do that for people. But I'm never going to put myself in that position, because there are too many variables in this situation that can't be controlled, right? There are too many elements of the policy itself that I'm not going to be able to control as an agent. So if I can't control it for you, the client, then I'm not going to do it, right? Like all the things I showed about the indexes, you look at every company that has those index options. I don't know if you realize this or not, but did you know every company has the ability to just change those indexes on an annual basis? The indexes that you buy the policy right now, today, in 2024, and you have this policy for the next 20 years, if you're lucky enough to have it last that long, and then you go to use it, the indexes that you have access to might not even be the indexes that were available when you bought it. Think about that. It's insane. But this is what people are doing, right? People are buying into this crap and thinking that, somebody's going to manage your money for you. And it's just, to me, I don't know. It makes no sense. I don't see why people would do it. But no cap indexes can get you. They can get you big growth on an annual basis. There can be these one-time flyers, but the problem is these spread charges and these no risk rates will drag down. They will be an anchor on that long-term performance, especially when you take on the no risk rate, the spread charges, the cost of the insurance, the admin fees, the rider fees, the multiplier fees, like the bonus fees, like all the different things that they bring into it. It will come and bite somebody in the butt. So now what I want to do is I want to talk about selling off calculators, because this is something that I'm seeing more and more and more, and it is totally not compliant. And I'm going to tell you this. I've seen a couple people that are influencers online, and I'm going to warn people against them. I've seen a couple clients come my way. I've helped them actually get their money back, because that's how bad this crap is when it comes to people buying this stuff online. Now, what I'm going to do is show you an example of a calculator that's being used. Now, there are instances in using a calculator, or not a calculator, but using an Excel sheet. If you want to use an Excel sheet to say compare 3 different companies and put them all in line, and you actually have the actual just copy and paste of the ledger of the illustration, and you're looking at the Excel comparison of 3 different companies, and you're looking at the illustrations to go side by side with each one to be able to read the illustrations, and the Excel sheet is just a snapshot, that's one thing. I don't do that personally. I've seen people do it. I think that can be a great way to simplify things for people that are looking to make a tough decision between multiple companies. Okay, that's fine, because it's a quick snapshot, and then you look at all the individual illustrations, but you should never look even at that without having the original illustrations side by side. What I'm talking about is something else entirely different. So what I want to do is show you now, I want to show you this thing called the Flex method. And these are calculators that are used by a guy on YouTube that I have a big problem with. I have a problem with the way he sells. He endorses Curtis Ray's MPI strategy. They utilize the idea of borrowing against your policy to reinvest it in more insurance, and like to create this whole ecosystem of what I would call hyperfunding. And effectively, you're using policy loans, and you're using the fact that the illustration is going to provide 50 basis points of positive arbitrage or positive spread. So you can borrow at 5% and earn 5.5% according to the illustration, which takes so much risk on. It's absurd. But the problem is you can't really make it work long-term doing what they're doing and make it work on an illustration, because it's not compliant with the illustration. So what these guys do is they go out and they create their own calculators. And from that perspective, what happens is they go, and now this calculator, I just want to show you as an example, because this is a calculator, shows all the different moving parts. You can see net cash out, value after loans, cumulative profit, net death benefit, additional loans that you're taking on because they're using lines of credit out. And they put together this big spreadsheet that shows all of the stuff, total finance end of the year. And the whole idea here is they try to pitch this as a way of like, you only got to pay into your premium for 3 to 5 years. And after 3 to 5 years, it'll be self-sustainable. And you can use the policy loans to basically pay the premiums, and you're never going to have a problem. I promise you, if you're seeing this, it doesn't work the way these calculators work. You can see a lot of errors here. There's been some changes on this because of the fact that it's a sheet and they've changed the numbers around. But, and I don't want people's personal information being out there. But I got access to this, and you can see the information that they're sharing with people and what they're trying to do. And they're trying to utilize these calculators to be sales tools. And this is not only is this in my opinion, lacking integrity. It's not compliant. It's illegal. Like literally, you can get in trouble for doing this. And I can tell you, every time I've ever seen that happen, and there's been a problem, I've literally been able to go to the company and help them get their money back, because the insurance companies want nothing to do with that. Those kinds of sales tactics are just disgusting. And if you've had anything like that happen to you, make sure you go back through all your emails, keep track of everything, and make sure that you share it with the insurance company and get a refund and go do something better with your money. Because that using those calculators is one of the worst things that agents can do. It is an E&O coverage, just a policy claim just waiting to happen. And companies just don't want to deal with the bad publicity. They will just give you your money back and not deal with it. I would love to see these companies actually punish the agents. But once again, that just shows how bad the companies are and how complicit the companies are in just wanting to get the business and hoping that nobody's going to complain. But it's funny, as soon as you complain, they'll give you your money back. But if you don't complain, they're just going to keep it, and they're going to let people keep selling like that. And if somebody wants to get loud, they're going to just give your money back and shut up about it. And hopefully you don't get loud about it is really what their perspective is. So that's a big thing. So what do we got now? We got IUL will provide guaranteed tax-free income. All right, this is going to be a fun one. Let me go here. What I'm going to do is I'm going to go here. Let's take a look at this. So here's the idea. And if you've seen this, if you've seen one, you've seen 100 of them. You can see here we got the premium outlay. This guy's paying $12,000 a year. You can see he's 41 years old, policy year one. And at the end of 10 years, he's got 120,000. At the end of 20 years, at 60 years old, he's paid 240. And then he's able to start taking $37,000 a year of income off of the policy. Now, this has $433,000 of cash value, which is the assumed value. And remember, all these years that this policy did this to get to this number right here, assumed 0 down years. That's what the assumption was. And I showed you before, 35% of the time we're going to have down years. So this policy to get to this point won't even have this. Now they're showing the assumed illustration based on the current assumptions of all the variables based on the policy, which we've already discussed are not conservative. And so now when we get to the next page, we're looking at this. I'm going to take this. I'm going to just kind of start this part over again. And I want to show you what happens with this stuff, because what's going to happen here is you got the income, but what's also happening is you have loans coming out of this, right? So you have these $37,000 a year of income. You can see by 70, you did that. It's $378,000 so of income. So yeah, if you could pay 240 in your first decade of retirement, take out 378 and still have money left, that sounds like an amazing deal. But the problem is not that. The problem is when you dive deeper. And this is why you always have to run policy illustrations with the illustrated income, because otherwise it won't show you the policy loan ledger, right? And what's important to understand, and I have it written here, you got 50 basis points of positive arbitrage every single year on here, right? So you see the index loan, fixed loans, loan charges, and loan credits. This is a really good breakdown. I like this company because every company functions this way. This company is at least transparent with the way they do it. So you can see here that this company does $37,000 as the loan. The loan charges are $1,026, and the loan credits are $1,168. So you're making that $1,168 minus $1,120 or $1,026 is the positive spread, right? $146 of positive spread year one. Okay, so that's great, right? It sounds really good. But the problem is now you have an outstanding loan balance because you're not paying it back. Because let's face it, you're in retirement. You're not taking retirement income to pay interest expense on your loans, right? So now you have that $38,900 loan. The next year you take out that. But here's the deal. I want to jump to the next year because this is where it gets juicy. This is where it gets dangerous. Remember, every year going into this has been assumed on the illustration that you're having a positive year, okay? Now, at this point in time, just 10 years into retirement, what's happening here is that you have a loan balance, outstanding loan balance right here. Your outstanding loan balance is right here, the 489. That's your outstanding loan balance. Your cash value is less than your outstanding loan balance. So the risk reward goes crazy. So in this scenario, you could see it's assuming you got $110,000 in loan charges and $127,000 of loan credit. So you got 17,000 ish of loan credits above and beyond what the charges were, so that you've earned $17,000 just in having your money go through the IUL. That's what they're going to sell you at right there. Just that. The reality is it's not going to happen that way. This is assuming no down years. So 35% of the time, meaning 3 out of those 10 years, you're going to have extra charges and fees above and beyond what you've earned. Like meaning these loan credits, like this 1 year, like if we have one bad year, right, where we have loan charges, look at this. One bad year at year 19. Remember, we've got 27,000 or 17,000 in positive loan credits above and beyond the loan charges. Now, what happens if we have one bad year at age 69 and the loan credits were 22,000? So if we take off those 22,000, now all of a sudden we have an extra fee. We have an outstanding loan balance of 429, but now this 22,000, we go 341 minus 22,000, and we got 319,000. 319,000 is the cash value we have here, not the 341. I can show you a lot of this. The bottom line is the numbers are assuming positive years every year, when 35% of the time the market's going to perform worse than what you're looking at, worse than the loan costs. You're actually going to incur an expense. And remember, like with the spread charges and the no risk rates and the cap rates and all these different things, at the end of the day, I went back to how you're participating in the market. You have the options budget, the options cost, and so it doesn't matter what the index rate is. I don't care if you have a no cap rate index, right? I don't care if you have a cap of 10%, a cap of 8% with 100 or 200% par rate. It doesn't matter. At the end of the day, if we're talking about an S&P 500 index, all that matters is the options budget and the options cost, and you can do whatever you want with these. But if it's the S&P 500 is really what you're buying the options are, at the end of the day, it doesn't matter what you do for the cap rate, no cap, different par rates, all this stuff. You're still dealing with the same options budget, same options cost. So the end long-term result is going to be the same. This whole marketing of no cap rates for long-term growth is just a marketing tool that doesn't really hold any water. The only water that it holds are people that say, I'm going to manage your portfolio for you, in which case, if that's the play, please just run the other way, because nobody should be putting themselves with a fixed product in a position to manage your money to that accord. That's just my take on that, right? Like, I think that's just irresponsible, and I think you're putting your life in the fact that they're going to be around when you need them to be, and I don't think that's wise. It's just not smart. It's just not smart, decisions. So when we look at this, what happens? I'm going to go back to this other slide. What happens is we go down the list here, and you can see here by the time we hit 76 years old, even with a positive year every single year on this illustration, you got a $920,000 outstanding loan balance and only $271,000 of cash value. What's going to happen? Well, if we go to the next year, just to make it, you got $1 million at a 5% loan rate. In this scenario right here, you're looking at a $50,000 expense. Now, $50,000, you could see the cash value. If the market went down that year, you could see the loan credits were $54,000 and the loan expense, because in this sense, I think this is back when the interest rates were lower on loans. But you're looking at, assuming a 5% loan rate, you're looking at about a $50,000 loan on $262,000. That's over a 20% loss, or it's about a 20% loss of your net cash value. And make no mistake about it, that's what's going to happen. And when you have that 20% loss, if you don't have 262 the next year, and you can see that 262 is shrinking to 254, shrinking to 247, and then 240, that's because of the net amount at risk. And so if you have this negative $50,000, your net amount at risk is going to be bigger. Instead of 262, let's just say you had 212 for the sake of simplicity that year. Well, guess what? That's going to increase more insurance costs and all these things. So this dropping of the numbers will go down in a compounded fashion, and it only takes 3 or 4 years in a 10-year period while you're in retirement taking these policy loans for your policy to blow up. The reason it looks really good is because the calculator is based on 50 basis points of positive arbitrage. And the calculator is designed to show, hey, what's the maximum income I can do, without blowing up with this assumption of 50 basis points of positive arbitrage and no down years. Well, I got news for you. If you think that can happen, like, good luck. Go do it. It's up to you. It's your life. It's your family. You could do whatever you want to do. I'm just sitting here trying to protect you. A lot of people like to rip on me saying I'm doing this because I hate them or whatever. Listen, I loved these things. I drank the Kool-Aid. I'm doing this because I have gone through the process, and I've experienced what it's like to have clients actually have this stuff and buy it because I told them how it would work. Do it all the right way. Do all the right things. Be there to help them with it all, and then still have the policies not work the way that I thought they were going to. And when that happened enough, and you start to question, why the heck is this happening all the time, consistently, and you start asking questions, and then you realize the questions to your answers, or the answers to your questions are just not acceptable. You realize, like, holy crap, I can't do this anymore. And that's why I made the shift that I made, and that's why I became a whole life fan instead. Now, the next one is what do we got here? IUL is better than whole life for real estate investing. I just did a video on this. The problem with IUL is what I just showed in retirement, right? So I'm going to go back to that real quick. The bottom line is IUL doesn't work for real estate investing or infinite banking because of the fact that the guarantees and the predictability matter. There's enough predictability challenges in the real estate markets and the stock markets and things like that. You don't want there to be unpredictability in your IUL policy, in your life insurance policy in general. That's why we use whole life for infinite banking and real estate investing. And that's why I wrote my book, Cashflow Hacking, about this, because they create the predictable foundation. The whole life policy is where the life insurance takes on all the risk. The IUL policy is where you put your money in, you take all the risk, and the insurance company decides what they're going to do with your money and protect their shareholders, right? That's it. When you have a whole life policy, you are participating with the success of the company, of the insurance company. That's the purpose. That's why you can start your own bank. That's how you can use it as a leverageable asset for real estate that will enhance things. When you do it with an IUL, what happens is you wind up in a situation like the ledger that I just showed you. And what's going to happen is you're going to have these outstanding loan balances. Let's say you had the money, you had the capital, and you got this outstanding loan balance of $264,000, and you have cash value of $373, and you use this 264, 663. Let's say you use that to buy a house, a rental house. Okay, but here's the deal: when you have that, now you're in a situation. Let me do some math here, because what's happening is you are taking on risk. If you have a whole life policy, you don't have to worry about this, because they're going to try to sell you the idea. An IUL agent is going to try to sell you the idea that you have the ability to earn positive spread. But I've already shown you, if the principle of how these things work in retirement doesn't work, well, then that principle is going to transition over into real estate. So if what I just showed you about retirement income and how they don't work for tax-free retirement income because of the risks, well, the same principle trails down into the infinite banking concept, into real estate concept, because what's going to happen here is we've got 264, 663 times, and you got 13,000 of extra costs. Now, 13,233 of extra interest expense. Now, I don't know about you, but if the market's going down, if the real estate market's challenging, maybe if rental prices are not what you want them to be, or you lose tenants and it's harder to fill a house, and maybe you have a vacant house or whatever, even if you have a positive situation, my guess is most people, cash flow is challenging. And having an extra 13,000 interest expense, if you have maybe one or two houses on this $264,000 that you used to buy, this is going to be a real big problem for you, right? These are the uncertainties that IUL throw into your real estate investment portfolio that nobody is talking to you about. And so, I've done more videos on how to use real estate, how to use whole life insurance to invest in real estate. I wrote my book, Cashflow Hacking, on that topic. I'm down here at my place in the Dominican Republic. We just bought a hotel with a private equity fund and utilizing the strategies that I'm talking about. We relocated our entire family doing the strategies that I'm talking about. This is like, if you're going to follow it, I encourage you, anybody that says this is what to do, I ask you to go ask them, show me the policy that you used to buy the actual houses, your investments. If they're talking philosophically and conceptually and they've never done it themselves, I really, really challenge them. This is one of the reasons I started the IUL challenge. Most of the IUL agents out there on TikTok and Instagram that have gotten really popular, have gained hundreds of thousands, if not millions of followers, is because they're selling hype. They're selling sizzle, and there's no stake behind the sizzle. And the reality is they've only been doing this since 2019, maybe even less. And I don't care about what these policies have done over 1 or 2 years. I care about what they're going to do over 10 years. So I created the IUL challenge saying, show me a policy that's actually performed in the bull market, greatest bull market of all time, performed better or even just matched how it was illustrated. Now, if these things are supposed to give you upside potential, they should have illustrated, they should perform at least at the conservative illustrated rate during the greatest bull market of all time. I'm offering $2,500 to an agent that can do that. Nobody's done it yet. So if that doesn't tell you what's going on with these things, that it's all smoke and mirrors. And by the way, I'm not saying it can't happen. I want to throw this caveat out there as well, because then I get people like Doug Andrews, this clown that's just like creating all these, videos being like, oh, I've debunked you. Yeah, that's great. I didn't create the challenge to say nobody can win. I created the challenge to bring up the point that they only do what they're sold as doing with really precise management and really perfect funding. And even when they're perfectly funded, they only perform the way that they're sold about 5 to 10% of the time. So if you're buying this asset that you want to be a foundational component that's stable for the rest of your financial life, a 90% chance of failure or more is not a good place to start, in my estimation. That's just my opinion. I mean, call me crazy, but I don't know. That just seems to be common sense to me. So let's do this. Let's go. I think that was point number 5. And let's have point number 6. Oh yeah, IUL is better for infinite banking. So I kind of banged that one out too. You cannot do infinite banking with IUL. I've done a video on why Index Universal Life does not work for infinite banking. I would encourage everybody to go check it out, but you cannot do it. Once again, it all comes back to the fact that you don't have control over the moving parts. The guarantees, I would encourage you to think about it like this. When you buy a whole life policy, when you sign on the dotted line, you are becoming a partner of the company, essentially a shareholder of a participating mutual company. When you sign on the dotted line with an IUL, you are becoming a profit center for them. You cannot bank when you are a profit center for the company. You have to be a business partner that shares in the success of the company. My biggest challenge with IUL agents, and I really, really, really implore you to understand this. Think about this. Go along, go online, watch all the TikTok videos, watch all the little 30-second, 60-second clips, and what they're all going to say is, you want to do an IUL because these companies have been doing this forever. Life insurance companies are the most stable financial institutions in the world. They've been here since 1840 and been doing all this stuff. Guess what? That's true. They've been doing it with whole life that whole time. And as long as the life insurance companies stand the test of time, the way that they've been doing, then whole life policyholders are going to be super well positioned moving forward. But I got news for you. Just because the life insurance company endures through all these challenging markets doesn't mean your IUL policy is going to endure. If you have a whole life policy and you fund the premium and you meet your obligations, the rest of the risk is on the insurance company. Even in an IUL, you have the ability to fund the policy, structure it properly, fund it properly, and still have it not meet its goals. And when you start taking loans against it, the world around the policy can have problems. And when you're talking about using it for infinite banking, and you look at maybe the interest rates change and the options budget changes, maybe options costs go through the roof and cap rates have to come down and they just don't perform very well. Maybe the stock market, because of rising interest rates and higher unemployment rates and all these different things, maybe the cap rates go up. But because of that, because of the reasons and the environment that force the cap rates up, maybe that makes the S&P 500 or the stock market perform worse, which means a higher cap rate doesn't mean anything because the market's not performing well enough to get a return in the index no matter what. So IUL is full of so much unpredictability that you cannot use it as a banking alternative. That's why you cannot bank with infinite banking. Anybody that tells you that you can use IUL for infinite banking, like Doug Andrew and his bullcrap laser banking idea, those guys are talking and trying to sell you just on this one little piece of positive arbitrage spread when it doesn't work that way. Sorry for being fired up in this. Sorry for, kind of getting a little cutting with a couple people like Doug Andrew and Curtis Ray and Dan Thompson and these people, because to me, they are the worst in the industry. They are doing so many people harm. And what I see on a daily basis of people selling me or sending me their illustrations and kind of asking me for my input, and seeing people that have put hundreds and hundreds of thousands of dollars into these things and losing money, then you get, somebody who creates a video that says, hey, look at this policy, it's done well. Okay, well, first of all, you can cherry pick. If you've sold 1,000 policies, probably 50 policies that have done well. Good for you. That doesn't make you successful. That doesn't mean you've been noble in helping your clients. That's what I have to say. So anyway, hopefully these points have helped. Hopefully this level of education and deep dive helps. If you need more information like this is meant to be an overview, meant to get you thinking critically, meant to get you asking the tougher questions. And so if you want to dive deeper, I've got an IUL playlist that you can go deeper down, do more education. And that's that. I would say, just keep the educational journey going. If you're an agent, you owe it to your clients, you owe it to your family and friends and business colleagues that you're going to be sitting down with and trying to sell. You owe it to them to do this, and you owe it to yourself to become a better asset and really understand what you're selling before you go out and sell it, period, hands down. If you're looking to do this for yourself, I really, really encourage you to make sure you understand all the moving parts, all the nuances before making a final decision on any of it. I do believe in whole life insurance. I've got a whole playlist and a whole lot of content on why I love whole life insurance. I've written my book, Cashflow Hacking. I would encourage you to go to cashflowhackingbook.com. Get that. If you haven't already, make sure you subscribe to the channel. Hit the bell. That way you're notified every time I launch a new video. I do this all the time. Set up a clarity call with somebody on my team. If you are interested in this, if you want a policy evaluation, you can go to rescuemyiul.com and we will check it out. You just got to send us the illustrations of your IUL, the in-force and the original illustration. We'll break it all down for you. We really, whether you buy from us or not, or come, that is just a service that we're looking to do for people to add more value into the marketplace, to make sure that, if people can get their money back, if they, have the right questions, we can coach you through all the questions to ask. Just set up a call. We're here to help. Let me know if you need anything else. Comment in the comment section below. I'll do my best to engage with every single comment. This is a long video. Thanks for being here this long. Until next time, have a blessed, inspirational day. We'll talk soon. Later.